Terrence Andre Banks coming to you today from Information Age Financial Solutions with another fantastic book that you have to get in your arsenal. I'm not being compensated whatsoever for this. Just found great books that I'm going to keep bringing to your attention. Another one is The Education of a Value Investor by Guy Spier. Education of Value Investor by Guy Spier. As with all my other books, if I find a great one, I ear bunny them down and I might mark notes on it. Especially with coming in the time we're moving into, where the financial market is going to change. Different things are moving on, and it's changing at such a rapid pace. Value becomes the most important thing. This book is a little dated because he goes through his experiences prior to being in the financial crisis of 2008. And what I think we're going to go through, it may not be in the next year, maybe in the next year or two or a couple years down the line, but we will go through a financial correction. You need books like this to give you a clear mindset of what it was like in 2008. 2008 was a life-changing moment for me. I went through personal financial things that I couldn't even imagine. Through businesses being in and letting go some of my employees, having to sell them in real estate, having to close down different aspects of my business, having to reinvent myself and wondering how I'm going to get through this. And even if you made the right decisions and how that made you feel and even some of the gray hairs that I obtained because of going through that 2008 crash and it's surviving it. That's the biggest aspect, surviving through that particular time where a lot of people weren't able to reinvent themselves. A lot of divorces happened in that aspect. So this book just goes into so much detail about the lessons that we'll learn. I'm just going to kind of areas that I might have highlighted or just gave you information and respect. Also, because he's on the inside as a hedge fund manager, and at that point he tells about when his experience working with those companies and how that was being in New York before that time and talking about that. I was driven in large part by what Warren Buffett, he's a big fan of Warren Buffett, the outer scorecard, the need for public approval and recognition, which can so easily lead us in the wrong direction. Just a good point here. This is dangerous weakness for investors, since the crowd is governed by irrational fear and greed rather than by calm analysis. And what you've seen all those meme stocks and stuff like that goes against value here. Value investors have to be able to go their own way. The entire pursuit of value investing requires you to see where the crowd is wrong so that you can profit from their misperceptions. This requires a shift toward measuring yourself by our inner scorecard. Here's another good point. Our top universities mold all these brilliant minds, but these people, including me, still make foolish and often immoral choices. This also goes for my countless peers who, despite their elite training, failed to walk away from the nefarious situations in other investment banks, brokerages, credit rating agencies, bond insurance companies, and mortgage lenders. For university educators, a little soul searching would also not be remiss. It talks about that because everyone has a bone in it, but even in the universities, these brilliant minds, these people he explains in the book how they do some unscrupulous things at times. One of the things he learned in economics is, especially if you studied economics, the most important aspect is they talk about efficient markets. There's no such thing. The efficient market hypothesis, which is a powerful and theoretically useful assumption about how the world works. This hypothesis holds that financial prices reflect all the information available to participants in the market. It's really not true. That has profound implications for investors. If it were true, there would be no bargains in the stock market, since any price anomalies would be instantly arbitraged away. In the real world, this simply is not true, but it took me a decade to realize it. See, these are just some of the experts you're going to get from this particular book. My favorite part is the financial crisis. Unless you've been through 2008, you don't have any idea what that meant and how that can change you mentally, physically. It's just done the same thing. And he details that, especially for this, was he was coming into his claim to fame and having that. Value investors pride themselves on being able to buy when the market is imploding. Right? This is what everybody thinks they're going to do. We like to think that we possess the calmness, courage, and strength, not to mention the intellectual clarity and understanding to act rationally when almost everyone else is panicking. But what really happens when the market crashes and there's blood on the streets? I will find out this firsthand in 2008, 2009, when the financial world tumbled in the void, dragging me and my fund with it. As Warren Buffett has said, if you weren't scared, you weren't paying attention. God knows I was scared. Honest, real life things like that. And that's the thing that's missing. Sometimes people don't talk about what that made a feel if they especially been, because everything after that particular time has just been in a skyrocket of everything going up, defying all rules of financial financial stillness and market sense. We're just living in completely different times. But corrections happen, and people need to be aware of them. And books like this can help you at least be in the mental understanding of what someone who's experienced that is going from and survived from it, which is really the big point from that point. Experience the crash was sufficiently painful that it's difficult for me even now to write about it in total. The experience of the crash was sufficiently painful that it's even difficult for me even now to write about it in a totally honest and forthright. This isn't a conscious decision. There are memories from that time that I've no doubt suppressed because they are almost too wrenching to face. William Green, a friend and shareholder, is helping to write this book, recently reminded me of a call we had back then, which I told him, only half joking, we're bleeding from every orifice. That means every body part. I have no recollection of this at all. Still, there are certain moments from that time that are unforgettable, even if I would prefer to forget them. And he goes through all of this stuff. Bear Stearns was teetering on the brink of insolvency. My fund was broke. Client of Bear Stearns, and the firm held all of its assets in our various accounts. I remember my wife, Lori, exploding at me because I was so distracted and had been totally ignoring my family. I turned to her and said, don't you get it? All of Aquaman's fund money in this Bear Stearns. It could all disappear tomorrow. As a conservative risk-averse investor, I had intentionally placed all of our securities in Bear Stearns accounts that were fully owned by our fund. I knew that borrowing money and investing on margin can be catastrophic, since a brokerage firm can take control of the assets in margin account and sell them at the worst possible moment. I'll repeat that again. I knew that borrowing money and investing on margin can be catastrophic, since a brokerage firm can then take control of the assets in a margin account and sell them at the worst possible moment. This is effectively what happened years earlier to long-term capital management. I've been manically focused on avoiding such risks, acutely aware that I needed to protect our assets, and I didn't have a single cent of leverage or debt, either personally or in the fund. Bear Stearns was simply our custodian, which meant that our cash accounts were theoretically not vulnerable at all. Even so, the unpredictability of the situation was terrifying. In reality, we could say what would happen to these segregated accounts if Bear went under. All bets were off. The market correction happens, and especially of this magnitude, all bets are off. And we're seeing different things happen if you're paying attention to outside of the United States. If you were in the United Kingdom, England, what they did when they had to bail out that pension fund, and I've done videos in the past about how notorious these pension funds are and how we need to be more mindful of them. We're starting to see the cracks in the armor there. Lehman Brothers bonds. I was almost speechless. He goes into this guaranteed counterparty risk, the counterparty risk that people are not aware of. There's another one. I couldn't imagine how he could possibly step into this minefield. His dad actually had bought Lehman Brothers shares, and he couldn't believe it. He had to explain. He was very upset with his dad because his dad is one of the shareholders in his company. Guys come from a pretty wealthy background, and different than most people in that point. But it's still good to hear the mindset of someone who's on the inside, who's experienced that particular point, and came out of it. And he's talking about this honestly, and it's refreshing. He explained that financial advisor that one of the world's largest and most prominent banks had called him to recommend these bonds, assuring them they had a AAA rating from Moody's. Careful with the AAA ratings. Moody's is just a rating agency. At the time, and things changed, and people believe these different aspects. It's just such packed into different information for what happened at that time. It's one of my best sections in there. He goes through a checklist of things that he learned from here and things that he uses as when he's doing function from value investor, how he's changed his office, how he changed the place he lived, how he's created his own version of Warren Buffett's Omaha, where he lives at. He talks about the substantial instinctive part of the brain is subject to dire mood swings. Even if we're thinking that we're functioning rationally, we function a lot of times irrationally. We have irrational pessimism. Indeed, money-related issues often activate the sub-rational parts of our brain in situations of heightened financial risk. When we feel that we're in jeopardy, our subconscious instincts are activated. The neocortex can subsequently rationalize our decisions, which could be bad. marked this book with such things, bunny notes, bunny ears here. I just couldn't get enough of it. The point is that neat economic theories I've learned at universities didn't come close to describing the true complexities of the economy or the financial market. At the same time, I also come to see that our brains are hopelessly limited in the face of this overwhelming complexity. Whatever people telling you you're going to act rationally, I'm speaking from experience here, you don't. You make decisions on the fly. You try to control that point because if you've never experienced it, you don't know how you're going to react. Now, once you get through it, then you can say, oh, okay, these are the things that I've learned from, these are the things I made mistakes, and these are things I can get better at. But you have to experience that from. And the thing with people who don't have business experience or have a loss, a true loss, where you're not able to come back from it so readily and so quickly, you actually have to go through it for a while. It tends to make you kind of arrogant and discount someone else who's experienced that particular notion, and they become much more cautious if you experience different things of that nature. Even if you think you function from value and you're going to function rationally, this book is definitely one to take into consideration because you'll find out only through experience that, hey, you're not doing the right things. He talks about the impact of highly improbable, these big cities, extremism, how he tries to move away from anything dealing with the market. It goes contrary to what the Wall Street market is pumping, and we're constantly, especially in information, we're bombarded with terminals, every different things, memes, TikTok, all talking about everybody who's doing things and making money in the market, and you need to just cloud that out when you're making decisions for yourself and for value, if that's something you want to do. He uses the principles of Warren Buffett, where he states that he looks into the company as a business that he's looking to own. Over time, I don't share that particular sentiment but I see how that mindset can then get you into a position where you think of these companies like and keeping them for the long term. But I do believe investing in value. I just don't take that sentiment as these companies are thinking of them as a business that you own, because it's on the contrary to belief. Unless you have a large share in these stakes, in it, you don't really move the decisions. But let me give my opinion about this. Go back to the book itself. The constant barrage of bad news could easily be exacerbated. My rational tendencies, when I needed most, was to screen out the noise and focus on long-term health of my portfolio, which is good. Learning to tap dance. When he learned different things he took on as some of the hobbies he took that helped him in terms of investing. Even though it explains a lot of his life story through that 2008 process, things he's done to do investing. I love his checklist here. Investing tools. Stop checking the stock price, different things he learned over the time that he functions from a checklist of things he doesn't do. You'll see that in the book. If someone tries to sell you something, don't buy it. Never rule right here. Don't talk to management, which is interesting because usually people do try to talk to management when they're making these investment decisions, especially putting large stakes of capital in. He says that they can be biased, even if they're not meaning to be biased. They have a potential to sell. Because of CEOs and top management, no matter how charismatic, persuasive, and honorable they seem. So Jim Cramer always invests, talks to the owners and stuff like that to get the idea there. That's why he also talks about blocking out the news. You do your own research. He goes to his own aspects of going to the 10 Qs and finding out different information and tools that he utilizes to make the best decisions for that. What's another rule he has? Discuss your investors' ideas only with people you have no axe to grind with. Great principle there. If a stock tumbles after you buy it, don't sell it for 2 years. That's something interesting. I didn't think about that from that perspective. Again, this book is don't talk about your current investments. Great rule there. And it's just these investors checklists that he has and different rules that he's come up with that he's made up. I can't encourage enough that you should get this book, The Education of a Value Investor by Guy Spier. It's fantastic, even though it's dated with some information, because if you haven't been through when was this copyright here? The copyright was 2014. The first edition was 2014. This book is extremely valuable. Take it, read it, especially for the time we're going to go in and you can see a different mindset. Even if you don't think that you might relate to us, because we're living in slightly different times than from their point, where everything is up, and even if the market goes down 500 points, comes back again. But keeping the mindset of the lessons that he learned and he talks about is very valuable. Can't stress enough about taking a look at this book from Guy Spier, Education Value Investor. Don't think you'll go wrong by it. This video has been any value to you. Please subscribe, leave some comments, hit that like button, share this video. Until my next video for Information Age Financial Solutions, I'm out.